A Chinese billionaire just dropped $300 million on a single bet. He's shorting silver, not hedging, not diversifying, betting the entire stack that the price collapses. This is the largest short position currently sitting on the Shanghai Futures Exchange. 450 tons of metal, 30,000 contracts. He's all in. But while he was building that position, Donald Trump quietly assembled 54 nations in Washington. They sat in a room for 3 days. No cameras, no press conference, just mineral maps and supply chain documents. And when they walked out, they had rewritten the rules of the global commodities market. This isn't a trade anymore. This is a siege. And you're standing in the middle of it, whether you know it or not. Let me show you the pattern. Because this has happened before, 3 times in recorded history. Same sequence, same players, same ending. First, Rome. By the year 300 AD, the Roman denarius had been debased 17 times. The silver content dropped from 95% to less than 5%. Soldiers refused to fight. Farmers stopped planting. The currency became so worthless that people melted the coins down just to extract the trace silver that was left. Within 70 years, the Western Roman Empire ceased to exist. Verified. Then the Dutch, 17th century. The Dutch guilder was the reserve currency of the world. Amsterdam was the financial capital. Then they fought 4 wars with England. The debt exploded. They started printing to cover the deficit. By 1780, the guilder lost reserve status. The empire collapsed within a generation. Czech, then Britain. The pound sterling ruled global trade for 200 years. But 2 world wars and a mountain of debt destroyed it. In 1944, Bretton Woods transferred reserve currency status to the US dollar. By 1976, the pound had lost 80% of its value. The empire was finished. Pattern recognition, not opinion. Now look at the United States. $36 trillion in federal debt. That number is growing by $1 trillion every 100 days. The Congressional Budget Office projects $56 trillion by 2034. But here's what they don't tell you. That projection assumes no recession, no war, no bank failures. It assumes everything goes perfectly. When has everything ever gone perfectly? The real number will be much higher, and it gets worse. In March of 2023, the Federal Reserve created the Bank Term Funding Program. You've probably never heard of it. It's a facility that allows banks to borrow against their assets at full value, even if those assets have collapsed in price. Translation, they're printing money to cover up bank insolvency. They did this after Silicon Valley Bank failed. Then Signature Bank, then First Republic. 3 major banks gone in 8 weeks. The FDIC insurance fund couldn't cover the losses. So the Fed stepped in with a printing press. Same pattern, same sequence, same outcome. But the real warning sign isn't the debt. It's what the insiders are doing. In the last 18 months, corporate executives have sold stock at the fastest pace since 2007. Bezos sold $4 billion in Amazon shares. Zuckerberg unloaded $3 billion in Meta. Jamie Dimon sold his first shares of JP Morgan in his entire career. These are the people with access to information you'll never see. They sit in rooms with central bankers. They see the real numbers, and they're running. The smart money is leaving. You can't unsee it. Now let's talk about the man at the center of this war. His name is Banning. You've never heard of him because he operates in silence. But in Chinese trading circles, he's a legend. He made $3 billion betting on gold during the pandemic. He called the rally before anyone else. He rode it from $1,700 all the way to $2,600. Then he closed the position, took his profit, and disappeared. Now he's back. But this time he's betting against silver. He opened his short position in early January when silver was trading at $87. He added to it at $83, then again at $79. His average entry is around $82. Right now, silver is sitting at $71. On paper, he's up more than $40 million. He's winning, but paper profits aren't real until you close the trade. And that's where the trap is set. Because while Banning was building his short, the Trump administration was building something much bigger. On February 3rd, Vice President J.D. Vance and Secretary of State Marco Rubio hosted the Critical Mineral Security Ministerial Summit. 54 nations attended. The combined GDP of everyone in that room represents 2/3 of the global economy. They didn't gather to talk about trade deals or climate policy. They gathered to talk about one thing: control. Control of the supply chain for the materials that build missiles, semiconductors, solar panels, and electric vehicles. And at the top of that list is silver, because you can't build any of those things without it. J.D. Vance stood in front of those delegates and said something that should have made every short seller in the world panic. He said that despite all the focus on digital technology and artificial intelligence, the foundation of the modern world is still physical commodities. He said that current market prices are failing to reflect the true scarcity of these materials. He said that prices have been artificially suppressed, and that this suppression is a threat to national security. When the Vice President of the United States tells you that prices are being manipulated and that the government is going to intervene to fix it, that is not a forecast. That is a declaration of war. Here's why this matters. The world is currently burning through more silver every year than it pulls out of the ground. The Silver Institute estimates a structural deficit of over 200 million ounces annually. That deficit has existed for 3 consecutive years. It's getting worse, not better. There are only 3 ways to solve a deficit like this. 1, you mine more. But it takes 7 to 10 years to bring a new mine online. 2, you reduce demand. But demand for silver is being driven by solar panels and electronics. Those industries are exploding, not shrinking. Or 3, the price goes up. It has to. Because if the price stays low, miners go bankrupt, projects get canceled, supply shrinks even further, and the deficit becomes a death spiral, mathematical certainty. Now look at what's happening in the physical market. Right now, the spot price of silver in New York is $71, but in Shanghai, the spot price is $81. The futures contracts in China are trading at $99. That's an $11 premium over the Western spot price. That is not normal. That is desperation. It means Chinese buyers are willing to pay 15% more to get their hands on real metal right now, today, instead of waiting for a paper contract to settle. That's called a physical premium. And when the premium gets that wide, it means one thing. The physical market is screaming that the paper price is a lie. Let me give you another data point. Citigold, one of the largest bullion dealers in Australia, just suspended silver sales. Not delayed, suspended. They put out a statement saying they cannot source the metal. They have buyers ready to pay, they have demand, but they have no supply. The metal has vanished. Then look at India. The multi-commodity exchange just raised margin requirements on silver by 7%. Exchanges don't raise margins when everything is fine. They raise margins when they're terrified of a default, when they think that traders might not be able to cover their positions. It's a defensive move. It's a signal that the system is under stress. And here's the crucial part. They didn't raise margins on gold. They didn't raise margins on copper. They raised margins on silver. That tells you where the vulnerability is. And then there's backwardation. This is a technical term, but it's critical. Normally, silver costs more to buy in the future than it does today. That's because you have to pay to store it, insure it, and transport it. So the futures price is always slightly higher than the spot price. That's called contango. It's the natural state of the market. But right now, the spot price is 80 cents higher than the 3-month futures price. That's backwardation. It almost never happens. It means that buyers are so desperate for physical metal right now that they're willing to pay a premium to get it immediately rather than wait 3 months. It signals a total breakdown in the supply chain. It signals that the system is running on fumes. So let me ask you a question. If physical demand is this extreme, if dealers can't get metal, if exchanges are raising margins, if buyers are paying premiums, then why is the price dropping? Shouldn't the price be exploding higher? In a free market, yes. But this is not a free market. This is a rigged market. And the riggers are the same people who always rig it. The bullion banks, the hedge funds, the same institutions that have been fined hundreds of millions of dollars for spoofing and manipulation. They're doing it again, right now, because they have to. Look at the bigger picture. Everything is crashing. Stocks are down, crypto is down, bonds are down, real estate is softening. The US dollar is collapsing at the fastest pace since 1980. Just 1 year ago, the dollar was the strongest it had been in 2 decades. Now it's the second worst performing currency in the developed world. Only the Japanese yen is worse. When the reserve currency of the world starts to collapse, that is not a market correction. That is a structural shift. It's a vote of no confidence. Global investors are looking at US trade policy, looking at the tariffs, looking at the political chaos, and they're pulling their money out. It's called the Sell America trade. And it's accelerating. But here's where it gets truly dangerous. China is making moves that most people aren't even aware of. Treasury Secretary Besant just confirmed that China is developing a new digital currency for international trade. But this isn't like a normal digital currency. The rumors coming out of Beijing suggest that this currency will be backed by physical commodities, specifically gold. They want to use it to settle trade without touching the US dollar, and their actions confirm the rumors. Since 2013, China has sold over $600 billion in US Treasury bonds. They've dumped them. At the same time, they've doubled their official gold reserves. And the real number is probably much higher because China doesn't report everything. They're selling American debt and buying hard assets. They're preparing for a world without the dollar. So you have to ask yourself, if all of this is true, if the physical shortage is real, if nations are stockpiling metal, if the US government is intervening, then why did the price just crash 16% in 2 weeks? Because the crash was timed. It was deliberate. It happened in the week leading up to the Critical Minerals Summit. Do you think that's a coincidence? It's not. This was a coordinated attack. The The big players smashed the paper price right before the meeting to shake out the weak hands. They wanted to scare retail investors into selling. They wanted to create panic. They wanted to lower the price before the government stepped in to raise it. This is a classic bear trap. You push the price down hard, everyone panics and sells, and then the real move begins. We are not at the cliff. We have already walked off it. Let me paint you a picture of what this looks like in the real world. You wake up one morning and your banking app isn't working. You think it's a glitch. But then you check the news and you see that 3 more regional banks have failed overnight. The FDIC steps in, but the insurance fund is already empty. The Fed announces another emergency lending facility. Your money is still in the bank, technically, but now you can't withdraw more than $500 a day. That's a soft capital control. Then you go to the grocery store. Prices have doubled in 6 months, not because of a supply shock, because the currency is dying. Your paycheck still says the same number, but it buys half as much. You try to buy gold or silver as a hedge, but the dealers have nothing in stock. The premiums are 30, 40, 50% over spot. The paper price says $70. But the real price, the price you actually have to pay to get the metal in your hand, is $110. That's the wealth transfer. That's the moment when people who prepared stay afloat and everyone else drowns. Right now, we are in the eye of the storm. The sentiment got too bullish. Everyone was piling into silver. The leverage was extreme. And Banning saw it. He saw the opportunity. He saw that the market was overextended. And he struck. He shorted it with everything he had. And for now, he's winning. But he's not fighting retail investors. He's fighting the United States government. He's fighting a physical shortage that's getting worse every single day. He's fighting a global realignment of the commodity markets. And history is not on his side. Because betting against a shortage is the most dangerous trade in the world. You might be right for a week. You might be right for a month. But eventually, the physical reality wins. Eventually, the music stops. And when it does, the short sellers don't just lose money, they get obliterated. Here's what the data is telling us right now. Initial jobless claims just jumped to 231,000. Analysts were expecting 212,000. That's a massive miss. But the real horror is in the hiring data. Companies have stopped hiring. We just hit the highest number of job cuts since 2009. Let that sink in. We are back to great financial crisis levels of fear in the labor market. When layoffs spike and hiring freezes at the same time, that is the ultimate leading indicator. It means the economy is about to roll over. It means we are heading into a recession, whether the government admits it or not. And in a recession, currencies collapse, governments print, and hard assets become the only safe harbor. So here's the unresolved tension, the $300 million question hanging over the entire market. Does Banning get squeezed? Does that massive short position detonate the moment the Trump price floor actually asserts itself and the physical shortage tightens further, or does the deleveraging continue? Does the market still need to bleed, flushing out a few more weak hands and forcing more margin calls before the deeper structural forces finally overwhelm the paper system? Right now, the signals are contradictory, and that contradiction is exactly what makes this moment so dangerous. On one side, exchanges are raising margins, and historically that signals short-term pressure. Higher margins mean less leverage, forced liquidations, and more selling, the classic pressure valve used to cool overheated markets and regain control. That's what the paper market is saying. That's what the charts are telling anyone who only looks at price action. But at the same time, something entirely different is unfolding beneath the surface, something that doesn't show up on technical indicators. J.D. Vance is standing on a stage alongside representatives from 54 countries, openly declaring that the era of manipulation is over. He isn't hinting or implying. He's promising coordination, intervention, and a reset of the physical market itself. Governments do not speak this plainly unless the situation has already slipped beyond quiet control. And while the rhetoric escalates, the physical reality grows even starker. Dealers don't have silver. Inventories are gone. Premiums are exploding, and backwardation is approaching 80 cents, a level that signals deep structural stress. Backwardation isn't supposed to exist in a healthy system. It's a warning that the market wants metal now, not paper, promises later. That is the fracture line. The paper market is signaling sell, while the physical market is screaming buy. And those two messages cannot coexist forever. Someone has to be wrong, and when that contradiction resolves, it won't do so gently. The question is, who breaks first? Is it a single Chinese billionaire holding $300 million in paper shorts, betting that the old system survives just a little longer? Or is it the Trump administration, armed with policy tools, political will, a 54-nation coalition representing most of global GDP, and a physical shortage that cannot be printed, rehypothecated, or manipulated into existence? You can print contracts, but you can't print atoms. You can create endless claims on silver, but you cannot create silver itself when it isn't there. Eventually, Price must reconcile with reality, and when it does, the adjustment is not gradual. It's violent. The only remaining variable is time, and time is the most dangerous variable of all. Shorts can be right on direction and still go bankrupt if their timing is wrong. Longs can be early and still be correct in the end. That's what makes this moment so unstable. Everyone is leveraged to their assumptions. Let me be absolutely clear. This is not instruction and it is not advice. It's pattern recognition. The same pattern, the same sequence, and historically, the same outcome. Rome debased its currency and collapsed. The Dutch printed to fund war and lost reserve status. The British did the same, and the empire eventually followed. Empires don't fall first to invasion. They fall when the math stops working. And now it's our turn. The debt is unpayable, not difficult, but mathematically impossible. The banking system is functionally insolvent, propped up by confidence and accounting tricks. Insiders are selling, governments are repositioning, and now they're openly intervening in commodity markets. Not because something might go wrong, but because they know what is coming. This isn't speculation. It's arithmetic. You cannot stop a mathematical certainty. You can only delay it, disguise it, or push it into derivatives and footnotes until reality finally asserts itself. That is why this market is lethal for short-term traders. Volatility will be extreme, reversals will be violent, and the rules people rely on will fail without warning. This is the kind of environment that chews people up. But for those thinking long-term, for those asking where wealth survives during a currency collapse, the question changes entirely. Paper burns, promises break, and counterparties fail. Metal does not. It doesn't care about politics, elections, or central banks. It doesn't default, it simply exists. And when everything else begins to fail, existence becomes the most valuable asset of all. The smart money already understands this and is already moving quietly out of paper and into reality. The only real question left is whether you're watching the noise or whether you are watching the pattern.